Let's talk about GDP, or Gross Domestic Product, and the Department of Government Efficiency. GDP measures the total value of all goods and services produced within a country over a specific period. It's how we gauge the economic health and living standards. There are three ways to calculate GDP: the production approach, or adding value at every stage of production; the income approach, or summing up wages, profits, and taxes minus subsidies; and the expenditure approach, using the formula GDP equals consumption plus investment plus government spending plus net exports. When you have more imports than exports, it is called a trade deficit. The trade deficit in the US is currently approximately $75 billion per year. For quick comparison, GDP focuses on what's produced inside a country, while GNP also counts what citizens earn abroad. The difference lies in international contributions to the economy. Big difference. GDP during normal economic times will be around 2 to 3%, similar to inflation rates. During recessions, GDP typically drops. Take the Great Recession of 2007 to 2009. GDP fell by 4.3%. Other signs of recessions include rising unemployment and falling retail sales. Now here's a twist. The new Department of Government Efficiency, led by Elon Musk and Vivek Ramaswamy, aims to cut federal spending and boost government efficiency. They're talking about laying off thousands of government workers and eliminating entire departments like the Department of Education. But less spending would shrink the G in the expenditure approach formula. All else equal, this would shrink GDP in the short term, and the job losses would shrink the C in our formula, both leading to lower GDP. What are the long-term effects? Change in other areas of the economy is certain, so long-term GDP results are also uncertain. But these two factors would be a headwind to GDP growth. On the other hand, things like reduced taxes and regulation could lead to increases in investment, the I in our formula. And increased tariffs could decrease the trade deficit. That would not necessarily help increase GDP, but it could increase net exports, or the X minus M from our formula. The more money that is in the economy, the more economic growth should be, and the higher the risk of inflation. Inflation has been one of the main factors that has been driving market returns for the past few years. When inflation increases, the market tends to contract, and when inflation steadies or comes down, the market reacts positively. There are many reasons why the amount of money in the economy fluctuates, and government spending is a big one. There are so many factors that influence whether the economy is going up or down, or whether an individual stock is going up or down, but if all else remains equal, reduced government spending will negatively impact economic growth. At the same time, reduced government spending will likely help to bring down inflation. While certain industries will be affected more than others, reduced inflation should be a good thing for the overall stock market. It would also be helpful over the short term for the bond market because decreasing interest rates result in increasing bond prices for existing bonds. So what do you think? How will Doge affect the economy and securities markets? Drop your thoughts below.